All right, let's dive in. We're talking about how to build a portfolio for what you might call an age of controlled disorder. And to do that, we're putting two heavyweights in the ring: the ancient king, gold, versus its disruptive challenger, Bitcoin. This is a battle for the ultimate safe haven crown, and you're about to see who wins.
So here's the question that's really at the heart of it all. For years, the story has been that Bitcoin is digital gold, right? It's supposed to be your hedge against chaos. But is that what actually happens when the markets get shaky? We're going to follow the data, because what we saw happen in 2026 paints a surprisingly clear and, maybe for some, a shocking picture.
So why this obsession with safety all of a sudden? Well, it's pretty simple. Investors are trying to navigate an economic landscape that feels like it's riddled with tripwires. We are absolutely in an age of anxiety, and it's being driven by some very real and very, very large numbers.
And here is one of the biggest numbers out there. The U.S. public debt to GDP ratio, it's sitting at around 120%. Now, this isn't just some abstract figure you see on the news. It represents a massive debt load that the government has to pay interest on. Back when interest rates were near zero, that was manageable. But as rates climb, the cost of just servicing that debt explodes, and that puts immense pressure on everything. And it really makes you question the long-term stability of traditional currencies.
This quote just nails it, doesn't it? It's not one single thing. It's a combination of those rising interest rates making the debt more expensive, it's geopolitical shocks popping up all over the globe, and it's that lingering economic hangover from the pandemic. This nasty cocktail is exactly what's forcing everyone to search for assets that can truly weather a storm.
And when that storm comes, the classic port for investors has always been gold. It's the original hedge. It's the asset that has held its value through empires, wars, and financial crises for literally thousands of years. So why does it still work?
Gold's appeal, really it just boils down to three core pillars. First, it's physical. You can hold it in your hand. It's not an IOU from a government or a bank. Second, there's just incredible historical inertia. For millennia, it has simply been the ultimate store of value. And maybe most importantly, it's a primary reserve asset for central banks around the world. That gives it an institutional stamp of approval that's just unmatched. It literally exists outside the system of government printing presses.
And check this out, because this illustrates a seismic shift. By 2025, central banks, especially in emerging markets, started holding more gold by value than U.S. treasuries. Just stop and think about what that means for a second. This wasn't just individual investors getting spooked. This was a clear signal from the biggest financial institutions on the planet actively moving to diversify away from a purely dollar-based system. They were de-risking in real time right in front of us.
But that huge move by central banks happened just as a new contender was rising. For the last decade or so, a really powerful story has positioned Bitcoin as the heir to gold's throne, a modern, digital answer to the same old problems of currency debasement and systemic risk.
And this is the central claim right here. The whole argument is that in a digital world, we need a digital store of value. Bitcoin was engineered from the ground up to compete with gold as a non-sovereign asset, one that can't be inflated away just by someone at a central bank hitting a few keys on a keyboard.
So let's just break down the comparison. Gold is physical, ancient. Bitcoin is digital, modern. Gold supply goes up a little bit every year as we mine more of it, but Bitcoin supply, well, it's mathematically hard-capped at 21 million coins forever. This absolute, verifiable scarcity is the very bedrock of that whole digital gold idea. So while gold is the traditional reserve, Bitcoin is making its case as the treasury asset for the digital age.
And look, it's a powerful theory. It makes a lot of sense. But theories, well, they have to survive contact with reality. And the market turmoil leading into 2026 gave us the perfect stress test. This is the moment where that digital gold narrative crashed head-on into the cold, hard data.
At the end of the day, this is the only question that really matters for an asset that claims to be a safe haven. It's easy to look good when all the markets are going up. But what happens when the tide goes out? What happens during a sharp, fear-driven market crash?
Okay, let's rewind to the first major test, the COVID crash. Gold, well, it did its job. It fell only 2% and showed a moderate link to stocks. But look at Bitcoin. It plunged nearly 30%, almost in perfect lockstep with the S&P 500. Its correlation hit 0.91. That means they moved almost identically. So in a crisis, when investors were scrambling for safety, they sold Bitcoin just like a high-risk tech stock, not like digital gold.
Now, you might think, okay, that was a one-off, a sign of a new asset finding its feet. But as institutional money flooded into crypto, especially with those spot Bitcoin ETFs, and it got more woven into the traditional financial system, something surprising happened. The pattern didn't break. It got stronger. Why? Because institutional trading desks use algorithms that put all high-volatility, high-growth assets into the same bucket. Bitcoin was now being traded by the same models that trade tech stocks.
And here it is, the definitive number from 2026. The data shows Bitcoin's price correlation with stocks solidified at over 70%. What that means in simple terms is on any given day, when the stock market went down, Bitcoin was highly likely to go down right along with it. That single fact fundamentally changes its role in a portfolio. It wasn't acting as a hedge, it was acting like a leveraged bet on the same things driving the rest of the market.
And this quote from our source material just makes it crystal clear. The myth is busted. The reality, confirmed by how the market actually behaved in 2026, is that Bitcoin performs as a risk-on asset. When investors are feeling optimistic and chasing high returns, that's when risk is on, Bitcoin does great. But when fear takes over and investors just want to protect their capital, when risk is off, it performs poorly.
So, what does this mean for you? How do you actually use this information? It means the playbook for building a resilient portfolio has fundamentally changed. We have to start classifying these assets based on how they actually behave, not based on a popular story or narrative. And let's be absolutely clear what risk-on means. A risk-on asset thrives on optimism. Think tech stocks, emerging markets, high-growth companies. The data now firmly, without a doubt, places Bitcoin in this category. It belongs in the growth part of your portfolio, not the safety part.
Now for a really crucial insight into how markets work. The dangerous gap between how regular investors and institutional investors often act. When fear is at its peak and gold is hitting new all-time highs, that's often when retail investors pile in, driven by pure emotion. But here's the brutal truth. That can be the exact moment that smart, institutional money, seeing the panic as overblown, is quietly selling its hedge and rotating back into beaten-down, risk-on assets, like tech stocks and now like Bitcoin.
And this chart basically visualizes that professional playbook. An institutional portfolio might use gold as a 5 to 10% true hedge, a kind of ballast against downturns. But they would put Bitcoin in the alternatives or growth bucket, right alongside venture capital or other tech plays. They're using the two assets for completely different, in fact, totally opposite purposes. It's simple. Gold is for defense, Bitcoin is for offense. One protects you in the storm, the other helps you sail faster when the sun comes out.
So we end here with clarity. The market itself has told us what these assets are. Bitcoin's story isn't one of failure. It just succeeded in becoming something different, a high-volatility, high-upside digital asset that behaves a lot like a tech investment. And gold? Gold remains gold, the slow, steady, millennial-old hedge against true systemic disorder. The playbook isn't about choosing one over the other anymore. It's about using them for what they actually are. So the real question for you is this. In your portfolio, are you playing offense and defense with the right players on the field?